connect with Rana Gupta and let's understand his global view. Why are emerging markets off to a poor start and why the excesses in the US market are not getting under check? Rana, fantastic to have you back. Thank you for joining us. The template for the market at the beginning of the year was that emerging markets were cheap, China is a comeback trade, US is bloated, and it's a matter of time US will start reversing. But the early trends are indicating that the US markets are still sucking a lot of global capital. Outflows have started not only from India but from China as well. Why are we off to a poor start for emerging markets again?
Hi, good morning, and wish you and your viewers a very happy new year. I think China, as far as China is concerned, is cheap, but there are still no decisive growth-oriented stimulus that has come from the policymakers. To be clear, China central government has the capacity, but it has not happened yet. What has happened instead is that there is a floor put under the growth slowdown, but nothing to pick up as yet. As far as the US is concerned, I think the earning growth in US continues to be very good, led by the Magnificent Seven and then the tech sector. That's why it's sucking a lot of global capital. More importantly, specific to emerging markets, I think what is also hurting it a bit for the beginning of the year is the uptick in US yields, because you must have seen that US 10-year yields have gone up quite a bit, and the strength in US dollar. These two is hurting emerging markets in addition to a subdued growth outlook, predominantly from China and some other emerging markets.
So what is the best way to understand that? What could be the India positioning for global investors? I mean, this entire so-called stepmotherly treatment of outflows of about 2-3,000 crore on a daily basis, do you think this could extend itself well into this quarter as well?
Sure, the outflows need to be seen in perspective, right? You look at the absolute number, that's fine, but you should look at a percentage of the market cap. And if you did that, I think you will see that outflows are happening from most of the emerging markets. That's the first point. Secondly, I think these outflows are not unique to India, as I was mentioning. These outflows are seen in other emerging markets, and as a percent of GDP, as a percent of market cap, they are about the same. As far as India is concerned, if I take a slightly medium to long-term view, the thing is that India will not be that exposed to the events that's going to happen this year. For example, US trade war. Now, India's goods export to US to GDP is only 1%, much lower than its emerging market peers. As we have described in the beginning, that US dollar and US yields are going up, that could hurt a lot of emerging markets with a lot of external debt. India's external debt situation at 16% is again one of the lower side. So I think India has some of the resilience to withstand all this. And as the dust settles, as Trump administration takes hold, we believe that some of this resilience will come to the fore, and that should maybe force some of the FPIs who are selling to relook at this position. One last point I will add on this: since FPIs are selling in the event of India's weight in the benchmark increasing, in our understanding, many FPIs would have turned neutral or even underweight. So I think given India's long-term potential, I don't think it can be ignored for a very long period of time.
All right. Hi. Good morning, Mr. Gupta. This is Shrishti also joining in. But in the near term, Mr. Gupta, all eyes will be on the budget as well. So which are the sectors, as per you, which can see the impetus there? Because, I mean, there's been a large infra-led push that we have seen in the past 5 years. But do you believe that the thrust will continue to be on that, or there could be little more focus on the consumption side, as both of these sectors are key to watch out for from the market perspective as well?
Sure. So let's take a step back and look at, if I break this in NDA 1, 2, and 3, 14 to 19, 19, 24, and then 24 onwards. The first 5 years was about formalizing the economy, which boosted the tax rates and the tax to tax collection, tax to GDP. The next 5 years, 19 to 24, was about laying out the public infrastructure as well as giving corporate incentives to capture the China Plus One opportunity as well as increase domestic manufacturing. Now, so the government's balance sheet is improved, capital stock is improved. To complement that, you need employable and available labor. So I think going forward, you will see a lot of focus on that aspect, which only complements their previous policies. And one can look at these labor-oriented policies and how to play. I think this will be more in terms of skilling, education, healthcare, some of the housing related spending, so on and so forth. I want to be clear, this is not populism. This is much required prioritizing of expenditure to development, to develop labor and make sure that they are available.
This is Anish also joining in the conversation. So what's the best play to play this as far as stock markets are concerned? Are you recommending to be in those mass consumption names, or is it better to play through industrials and capex focused stocks? What's the best way to drive this momentum?
Sure. Let me start with industrial and capex first. I think industrial and capex growth for last 3 to 4 years had been very good. I think 25% increase or even higher in government spending. Now we do not expect that kind of momentum to continue, which some of the stocks are factoring in. So industrials linked stocks, while the companies will do well, I think the valuations are way too high, and that kind of expectations will not be met. On the other hand, if I look at the consumer stocks at the margin should stabilize or even benefit from these policies, but we are also mindful that Indian consumption stocks are also battling with several other headwinds, not least the disruption in the quick commerce that we have seen, or even the urban consumer middle class slowdown that we have seen. I think the way to play this will be through stocks like cement. The way to play this through also stock like the tractors. So cement and tractors and rural focused lenders of secured loans. I think those are the three segments that can benefit from what we're talking about.
Tractors. Why? I mean, that's a very unique idea. Only one player is there in tractors. No, tractors is a very unique idea. Only one large player is there in tractors, then the other ones are pretty much the small players. So when you say tractors, I've not heard fund managers say tractors. Either they would say SUVs, they would say autos, they would say two-wheelers, they would say EVs. Tractors is something very unique, right?
Yes, I mean, yes, you're right. There's one large player with 40% market share, but that there are other players. There are other 60% of the market. Some players will increase market share. And also there are tractor components that one can play. So I agree that this sector is not a very, very large one, but still I think this one sector looks pretty attractive and sizable one, I would say.
What is that big, contra call for you for this year, where everybody either there's a consensus bearish view or there is a consensus bullish view? Where do you think it's time to look the other way?
I think in our understanding in general, people are bullish on the industrial capex driven names. And on that, I laid out our view that we think stock price wise, they're way too overvalued. Although the capex push from the government will continue, we are not so sure about private capex broad basing and picking up like the way the market expects. So in general, the stocks that are linked to both the government and private capex proxies, we will be very selective there, but by and large, we'll be a bit cautious on those themes. On the other hand, you can see that the financials, they have been a subject of a lot of negativity. The stock price have underperformed and so on and so forth. At the margin, what we think will happen is that liquidity will improve. This will help the banks which have struggled with deposit growth, and it will also then in turn help in growing their loans. That's first point. Second point, I think in the last quarter results, a lot of concerns came to the fore in the areas of unsecured loans, credit cards, personal loan, and microfinance. We are still cautious on microfinance, but we do not think the stress in the unsecured credit and personal loan credit card is going to continue for a very long time. In fact, our channel check suggests that you could see some stabilization in next 2 quarters. So these are not structural or long-term issues. This is just a mid-cycle issue, and the stocks have reacted, I think, far too negatively. So therefore, I think financials is one space where we see many opportunities at many levels.
What end of financials? Is it the large private banking names? Is it the PSU banks, or is it NBFCs and the other stock market ancillaries, or even insurance, because it's become a really large and differentiated sectors?
So we like the large private banks. This is the first thing. We like this space. We also like the non-banks which are exposed to rural areas, like we just were mentioning earlier, and we like the secured space there. And we also structurally like the wealth management plays, because I think in India the wealth is actually occurring at the top. And these families or wealthy entrepreneurs, they need differentiated services. I don't think they're just happy with mutual fund and equities. They need several kind of structured products, pre-IPO investments and so on and so forth. There are very few players who are capable of addressing that kind of demand. And we think that this is one segment which can see structural growth. And there's also a very good play on the financialization theme. On your question, insurance is also a broader part of the financialization theme. But within financialization, we prefer the top-end wealth management companies.
Those are the sectors that are looking great. But Rana, help us with your take on the PSU banking, PSU space as well, because I was just referring to some of your earlier interactions. Then you do find some value over there in select pockets, maybe power for sale, but they have seemed to be taking a back seat as of now. So any of the segments that are looking attractive to you at this point in time?
Sure, I think the PSU stocks, by and large, they have a very strong positive correlation with government spending on industrial and capex. If you look at this interaction, I mentioned that although that has grown at 25% CAGR over the last 3 years, therefore those stocks did very well. That kind of rate of growth, probably will not continue and will rebalance towards more labor. So as a result, I think what is priced into the stocks as strong growth and going on for years, I think that is that outlook will get challenged a bit. So although the PSU companies, I think at a company level, they're doing quite well, but the kind of expectation that got built in over the last 3 years due to government capex and all other things, that kind of pace may not continue. So going forward, I think I don't see a big trigger for them.
So, Rana, I have a very simple question. Earnings for FY26, according to all brokerage estimates, are likely to be in the range of 10 to 12%. And the Nifty targets for everyone at the end of the year is about 10 to 12%. So, what is the context here? That markets will give you return which is in line with estimates?
Oh yes, I think our view is also that this year there are certain global challenges. Although India looks better, but India will not be completely immune from the volatility that's going to come. The saving grace is India's good macro balance sheet and at 11 to 12% earning growth, which is lower than previously thought, but nonetheless still solid. And in this kind of scenario, I think it's best not to expect any further re-rating and overall broad stock market returns in line with the earning growth. I'll just make one more point on this. If you look at Indian stock market, Nifty predominantly, returns over last 10 years, 10 years is a long enough period to factor in various up and down cycle and various global peaks and troughs. In last 10 years, Nifty has given 12% annualized return, 10% comes from 10 or 11% comes from earning growth, 1 to 2% comes from PE rating. So in any case, over the longer term, earning growth is what supports the market. PE rating or de-rating impacts the return from 1 year perspective. This is 1 year where we think that PE or de-rating might not play a big role. It will be largely back to earning growth. But if we are right that India kind of shines through in this emerging market, let's say less bullish atmosphere, and Indian policymakers do the right things to support growth, then I think by the end of the year, you could see earning growth and PE pick up, but not during the first half or even first 9 months of the year.
Okay, Rana, on that note, we let you go. Really appreciate you making time and speaking with us and wishing you the best in 2025.
If you like this video, then like, share and subscribe to ET Now.